Hello, everybody. Professor Barth here, Associate Professor of History at Arizona State University. Welcome to the Dollar Report, September 2023. Pardon the tie. I just got done teaching class, history of money class, actually, in person here at ASU. An advantage of enrolling at Arizona State University, take an in-person class from yours truly. Hey, big number today from the Bureau of Labor Statistics, the CPI, Consumer Price Index. Not so good news. Inflation accelerated in August. Gasoline prices are getting a lot of attention today, but it's broader than just gasoline prices. We'll take a look at some of the data today. Core inflation, month over month core, exceeded expectations. The forecast was 0.2% increase in month over month core. It turned out to be 0.3. And so, with core CPI picking up, with the overall CPI year over year higher than people had expected at this point in the game, another Fed hike is certainly in play. There's 3 more meetings for the FOMC this year. There will be one next week and then another in November and December. Right now it looks like a toss-up whether or not the Fed will raise rates by quarter at next week's meeting. I think before the release of this data today, probably the bets were they would leave the rate alone. Now, maybe we'll see a 25 basis point hike at next week's meeting. We'll see. But here's a graph of year-over-year consumer price index. And you'll see it's higher than it was in the previous 2 months for the month of August. But yeah, certainly there's a decline since summer of 2022. But this is not where the Fed had wanted to be by this point, and it's certainly a lot higher than the 2% target inflation rate. It's double the target inflation rate. And so we're not out of the woods yet. Here's month over month CPI zooming in. What happened in the month of August, and boy, this figure is actually a little shocking. 0.6 increase in CPI for the month of August. That is the highest month over month increase since June of 2022. Okay? So highest month over month increase since June of 2022 at 0.6%. And then you look at core, excluding the more volatile sectors like food and energy. Core, a decline, but not as steep of a decline as overall CPI. Core has remained stubbornly high. Powell mentioned this at his speech late last month in Jackson Hole, Wyoming. Core is a problem, and it's not going down like the Fed had anticipated. Here's this from the Wall Street Journal. In the gray is overall CPI, and the purple is core. Core CPI is higher than overall CPI. And you'll see here the decline has not been as steep. But yeah, we do have that spike in overall CPI. That's driven primarily, it does seem, by gas prices. But again, there are other things at play here. If you look at month over month increase in core, higher than the prior 2 months. But, again, it has been a persistent problem for the Fed, for the dollar, over the last year and a half. April 2022 is when the tightening cycle began. Remember, the federal funds rate was basically zero. Upper limit was a quarter up until early 2022. And yeah, just the month over month change in core has remained quite high. And no signs of stopping, actually. Then when you look at just different prices, food has moderated a bit, but this is all relative. It's still up more than 4% for the year. That's unacceptable in any other environment. Of course, you compare that to last year. I mean, here's the month over month figures in 2022. I mean, we're just getting hammered one month after another of a 1% or higher increase in food prices. Now we're like, oh, it's only 0.2%. Well, you have a 12 months in a row of 0.2, 0.3% increase in food prices, and that adds up. But it appears to have moderated a bit. That cereal and bakery products up 6% over the last year. A lot of talk this morning about gasoline, gas prices up 6% in the month of August. The national average is $3.82 a gallon. Here in Phoenix, we're paying $4.59 a gallon. I don't know why it's so expensive here in Arizona, or at least in Phoenix, but we're paying a whole lot more than probably most of the viewers of this video. But gasoline went up 6% in the month of August. It's down 3.3% for the year, but certainly this number went a long way in contributing to some of the inflation numbers we're seeing this morning. Energy total went up 3.3% for the month. And here you'll see gas prices month over month since early 2022. Haven't seen a spike like this for a while. April, when gas prices went up 5.2%. Of course, 2022 was a wild year. Remember this in March when gas prices went up 20% in a single month, and then followed in May by 8%, June 10%, and things cooled off a little bit. We may be on the cusp of further increases in the months to follow. And then you look at some of these other figures. We won't review all of them. Of course, this is interesting here. Used cars and trucks down almost 7% for the year, down 1.5% for the month of August. Well, what's going on there? I think that's the high interest rates on auto loans. It's just it's doing a number to the market. These two figures, it seems, lately have just been, these prices have been going through the roof. Motor vehicle maintenance and repair up 12% for the year, up more than 1% for the month of August. Motor vehicle insurance up almost 20% for the year, and up more than 2% just for the month of August alone. I mean, that's a killer for American families. I mean, you look at the stats, and over half, I think it might be 60% or greater, number of Americans live paycheck to paycheck. You get slammed with a major car repair at these prices. That's doing a number on American middle class and working class families. And that motor vehicle insurance, even if you don't have a car repair, that every 6 months you get that updated bill, and boy, I don't know about y'all, but I got the last one I received. I was like, I had to do a double take. Like, what happened to the cost of my car insurance? It's gone a bit berserk. Shelter is up for the year more than 7%. That comprises roughly a third of the CPI. So here's where we are as far as the federal funds rate. Again, prior to the tightening cycle, it was 0. Now the upper limit is 5.5. And it seems like the Fed would have liked to have paused, and they still may pause at the upcoming FOMC meeting next week. But these latest numbers throw that into question a bit. But you zoom out, since 2015, we're dealing with quite a phenomenon here. Again, I think it's very naive to think we have a soft landing. More on that in a moment. The Fed's balance sheet, just an update here, is still a little over the $8 trillion, but it's down 10% since the tightening cycle began in April of 2022. And interestingly, in the minutes that were released for the Fed's July meeting, it said this about quantitative tightening. Remember, quantitative tightening began in summer 2022, where the Fed allowed a certain number of treasuries and mortgage-backed securities to run off the balance sheet as they mature. And from September 2022 to the present month, the Fed has allowed $95 billion worth of securities to run off the balance sheet. The minutes said this: all participants agreed that it was appropriate to continue the process of reducing the Federal Reserve's securities holdings, i.e. quantitative easing. A number of participants noted that balance sheet runoff need not end when the committee eventually begins to reduce the target range for the federal funds rate. So, in other words, whenever the Fed comes around to reducing the target range for the federal funds rate, and who knows when that will be. Some more hopeful people think next year, maybe 2025. Whenever that happens, it doesn't necessarily mean that the Fed is going to stop quantitative tightening. So that was an interesting inclusion in the latest minutes. There's M2, just update on M2. We're at $20.75 trillion, the money supply. That's down 5% since the tightening cycle began in April of 2022. There's the bank prime loan rate, the interest rate that you're paying on for ordinary loans. My wife and I had to take out a home equity loan for a not optional home project. I'll just put it that way. Foundation issues, anyway. And the home equity loan, we were able to get the prime rate, which was nice. We got the prime rate. It was 8.25%. Okay. If we had taken out a loan a year and a half earlier, well, we've been paying 3.25%. That's a big deal. And so this is going to have a widespread impact on the economy. And of course, credit card debt has now exceeded $1 trillion. What does that mean for those variable credit card rates? You have a whole lot of people in debt. And of course, what does it mean for mortgages? 30-year fixed rate mortgage has hung around 7% for a while now, about almost a year. But what it means is that you have fewer existing home sales. Existing home sales are down 18% in 2022. We don't have I was unable to find the current numbers, but this is from the Federal St. Louis Fed. Housing inventory, active listings, and actually since COVID, active listings have gone down. There's just fewer houses on the market. Actually, you drive around in any neighborhood, or at least here in Phoenix, you drive around and I don't see any for sale signs. There's just very few homes for sale. And so what has that led to? It's led to a boom in housing construction. Look at that graph. This is since 2020. Bam. Massive spike in home construction. Now, it's flattened out since 2022. Why? Well, because of this. Okay, look at that. In early 2022, the 30-year fixed rate mortgage has more than doubled. And so new housing construction's flattened out there, but still very, very high from where it was pre-2020. And then really, this is very, very interesting. This is somewhat of a tangent. But look at this. This is single-family home construction. I just saw this graph yesterday and had to comment on it. Single-family home construction. Here you see a big spike after 2020, from the beginning of 2020. Big spike. I mean, look at that. And then 2022 hits and all right, pretty big plunge. This is new single-family home construction. Well, what caused that? Well, people with mortgages the mortgage rates having gone up as much as they have, people are less able to afford, taking out a mortgage to own their own single-family home. Well, that's curious because if you look at this graph, new housing construction is flat. It hasn't gone down. It's flat. Well, so what's making up the balance? Oh, multifamily homes. Look at this graph. Since 2020, just shot up. And that has not gone down since 2022. This is where, at this point, single family home construction took a nosedive. Here, it's continued a dramatic increase. Why do I bring this up? Well, what it does is it highlights we're becoming a society of renters. People are unable to afford, again, taking out a mortgage to buy their own home. And so you're seeing fewer existing home sales are down. Fewer new constructions are single family units, and more of them are multifamily units for renters. Bidenomics for you. Okay? I find it interesting that the current president has embraced this term Bidenomics. They're really banking on this idea that we're going to have a soft landing and that they can, triumph and celebrate in 2024 for avoiding a recession. That's a risky move because I do not think that we are out of the potential of getting a recession yet. And you look at graphs like this. Is this a sign of a prosperous, thriving American middle class? I'm not sure about that. Dow Jones doesn't really know what to do. It's hanging around the early to mid 30s level. The 10-year Treasury is at its highest level since 2007. You zoom out here over the last 20 years. Look at that, highest level since 2007 at 4.25. The 10-year Treasury yield is up 186% since the beginning of the tightening cycle early in 2022. So that's quite a big increase, and it's had it's going to have a big impact on our national debt. The U.S. national debt currently stands at almost $33 trillion, which is just absolutely insane. The national debt has increased by 43% since COVID. 43% since COVID. Early in 2020, our national debt was $23 trillion. We thought that was a lot. Now it's $33 trillion. Well, guess what? The interest that the federal government is paying on that debt is rising, which with each and every year, the projection for 2023 is that the federal government is going to pay close to $700 billion just on interest on the debt. That's up more than that. That number is more than 40% higher than what the federal government paid in 2022. And the number in 2022, which was $476 billion, itself was 35% greater than the amount paid by the federal government in interest in 2021, when it was $350 billion. So, stated differently, the interest is going to become more and more of a burden. It's already just a little bit below defense spending. And time will tell what happens there, but for the long-term outlook for the United States, it's not good. Of course, the United States is not the only state struggling with debt. China, Europe, a lot of different states all across the world struggling with debt. So, is a recession coming? Well, Deutsche Bank, strategists over at Deutsche Bank think so. It's a U.S. recession is, quote, more likely than not. No soft landing here, Deutsche Bank is warning. That came out last week. Goldman Sachs disagrees, and they actually last week cut the chances of a U.S. recession in the next 12 months down to 15% from 20%. They also announced that they are confident the Fed will not raise interest rates any further. I would take Goldman Sachs analysts with a grain of salt. This recession is likely in 2024 because companies face a huge shock of having to refinance debt at high interest rates. Top strategists warns. And yes, and a real big issue is with the commercial real estate market. You look at the banks are heavily exposed to commercial real estate at the present moment. Look at this graph here. Commercial real estate loans since 2014, basically a 100% increase in commercial real estate loans. Banks are heavily exposed to this sector. Meanwhile, office properties are struggling. About $1 trillion of real estate loans and securities are coming due by the end of 2024. So banks are exposed. If you zoom out and look at commercial real estate loans over the last 20 years, you'll note that during the 2008-2009 financial crisis, the sector took a hit. Well, what's coming up next? There are a lot of people sounding the alarm bells. The delinquency rate is the percentage of loans that are past due, remains low. But again, to look at past periods, look in 2008-2009, the delinquency rate on commercial real estate loans, this is just commercial real estate loans, shot up to almost 10%. Now, what if something similar were to happen in this market? All right, so banks are, a lot of the banks are quite vulnerable. Moody's last month cut the credit ratings of 10 mid-sized American banks over concerns about higher interest rates and over concerns about the commercial real estate market. Lastly, the FOMC, or the Fed released the minutes for the FOMC meeting on July 26th, and the minutes, tell us a whole lot, but some important things. And so we'll take a look at that. Here's a headline from the New York Times. Fed officials avoided a victory lap at the July meeting. This is from the minutes. Quote, participants commented that monetary policy tightening appeared to be working broadly as intended. However, they stressed that inflation remained unacceptably high and that further evidence would be required for them to be confident that inflation was clearly on a path toward the committee's 2% objective. Well, the data we received this morning does not satisfy that requirement of further evidence. With inflation still well above the committee's longer run goal and the labor market remaining tight, most participants continue to see significant upside risk to inflation, which could require further tightening of monetary policy. And most analysts believe there's going to be at least one more 25 basis point hike before the end of the calendar year. Most people thought next week the Fed won't raise rates at all, but you got to wonder if maybe after this latest release, if the Fed may go ahead and raise rates another 25 points. A couple of participants indicated that they favored leaving the target range for the federal funds rate unchanged, or that they could have supported such a proposal. So apparently 2 participants at this meeting favored not raising rates at all. The Fed went ahead and raised it by 25 basis points at that July meeting. And then one more thing that I noted from the minutes on the possibility of a recession. Again, keep in mind this is in late July, a month and a half ago. The staff of the FOMC no longer judged that the economy would enter a mild recession toward the end of the year. However, the staff continued to expect that real GDP growth in 2024 and 2025 would run below their estimate of potential output growth, leading to a small increase in the unemployment rate relative to its current level. And then 3 weeks ago, Chairman Powell gave a speech at Jackson Hole, Wyoming for an annual economics conference and took quite a hawkish stance. He said, quote, although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. The process still has a long way to go. Well, I'll tell you, today's release did not change that hawkish outlook. So we'll see what happens next week. Thank you for tuning in. I hope that was just a helpful review of the latest data, and I'll see you next time. Bye.